Ladies and gentlemen, good day and welcome to the Q1FY22 Earnings Conference call of Pennar Industries Limited, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Good morning and very warm welcome to everyone. Thank you for being on a call of Pennar Industries Limited. We are happy to have with us management of Pennar Industries here today for question and answer session with investment community. The management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Shrikant Vakkat, Vice President Finance, Mr. J. Krishna Prasad, Chief Financial Officer, Mr. Manoj, Head Corporate Affairs, and Mr. K.M. Sunil. Before we start with question and answer session, we'll have opening comments from the management. Over to you, sir.
Thank you, Vikram. Good morning and a warm welcome to all of our stakeholders. I hope you and all of your families are safe and well. And my thanks to all of you for attending the Q1FY2022 financial results conference call for Pennar Industries. The structure of the conference call will be the following. I will first provide an overview and my comments on the company's performance in Q1. Our CFOs will then provide further details and cover major financial metrics. Post this initial summary, we will then take calls from our stakeholders and answer their questions. Pennar Industries had consolidated net sales of 488.28 crores for the first quarter of FY 2022. The consolidated PBT in Q1 was INR 9.03 crores, and the cash PAT, which is defined as our PAT plus the depreciation, was at INR 19.27 crores. Our annualized gross for the quarter was 15.5%. I will now speak on the three aspects we continually cover on our conference calls: profitability, liquidity, and growth. Q1 saw us achieve the PBT and capital efficiency targets that we had set for ourselves. We were at 3 crores per month as an average PBT, and that PBT number has substantially improved in Q2. We have a financial year PBT target that is substantially in excess of our current PBT, and we are well on track to achieve these numbers. Currently, we do not anticipate any margin pressures or declines in our PBT over the next few quarters. Consequently, we are very confident that Q2 PBT will be substantially stronger than Q1 PBT. Moving on to liquidity, we continue to target 75 days in terms of our cash-to-cash cycle or working capital cycle for the company. Currently, we are at around 100 days. Now, we had promised substantial progress on this from last time, and we have had progress in reduction of our current assets as a percentage of our revenue. However, because our accounts payable number also went down, the working capital did not move that much. That being said, we are quite confident that we will reach the 75 days target over the course of this year. And the excess working capital we are using will be liquidated, again, as I said, over the course of this financial year itself. And we will continue to make quarter-on-quarter improvements. Moving to growth, our BIW plant in Chennai has started commercial operations in late Q2, and they will become PBT positive in Q3. We believe this vertical is scalable and it's an important growth vector for our PBT going forward. Our metal buildings plant in Tennessee in the US has built a very strong order book and will become a very good contributor to PBT in late Q2 and Q3. Also, our CDW tube sales in the US, which are carried out by our US subsidiary, are also scaling well. And that business unit has already achieved positive PBT, in fact, ahead of schedule. For each revenue vertical that we have drafted a growth plan. We have identified key long-term opportunities, and we are confident that we will deliver consistent and sustainable PBT growth over the next few quarters. In conclusion, we are focusing a lot on our medium and long-term growth drivers. Over the medium and long term, our focus will continue to be on these three metrics: sustainable profitability, appropriate use of working capital, and ensuring that there's adequate liquidity. And lastly, ensuring that we have a sustainable growth plan for all of our businesses. We are confident we will have a very strong financial year 2022 and deliver growth quarter on quarter in this financial year. On that note, I will hand the call over to our financial controllers, Mr. Shrikant Bakkad and Mr. Krishna Prasad, for their brief on our Q1 performance.
Good morning, sir. I will take you through the financial numbers for the current quarter. Current quarter, we have seen a net sales of 488.31 crores. In terms of EBITDA, we are at 40.09 crores, which is 8.21% in terms of total percentage of the net sales. PBT has been healthy at 9.0503, and the PBT to net sales is around 1.85%. While compared to Q1 of last year, there has been a substantial improvement over the last quarter. Comparing with the Q4 numbers, the gross profit margins continue to remain stable at 38%. In terms of EBITDA, we are at 8.21%. Just take you through the further numbers. We had a cash profit of 19.1 crores, which last quarter was exceptionally high because of one-time profit on sale of the land and profit on sale of BIW tools, which we had last time. Our current net working capital is at 677 crores, while compared to 669 crores in terms of March. Overall, it is at 112 days in terms of the sales. In terms of account receivable, we have reduced from 106 days to 84 days. In terms of inventory, we have reduced from 193 days to 173 days. Overall, accounts payable also has declined significantly from 176 to 146 days. Our total long-term borrowings and the short-term borrowings continue to remain steady, and there has been not increase in the substantial in terms of the overall borrowings. We are at 591 crores as opposed to 584 crores as at March 31. We have a healthy ROC at 15.5% and ROE at 6.14%. So with this, if you have any further questions, we can take you through the numbers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, please press star and 1. The first question is from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Yeah, hi. Good morning, sir. So how we are looking the impact of the steel prices and inventory levels basically, and if you can highlight on particularly inventory side in terms of volume as well as the price impact.
Thank you. So steel prices have been on an upward trend for a long time. There was actually a lot of volatility in the prior 2 quarters. That volatility has now evolved into more of a steady increase. For example, in this quarter, we expect 1,000 rupee per ton increase. It could be 1,500 rupees per ton. So our focus is to ensure that there's not that much volatility. Whatever the steel prices, we ensure we manage that the prices we give and the payment terms we give to our customers are at a certain percentage, ROS are at a certain percentage contribution. So I wouldn't go so far as to say we're immune to steel prices, but what we don't like is volatility. Sudden rises and sudden falls represent challenges. I think there are sudden or massive rises and falls is behind us. So as long as these prices sustain, moderately increase, moderately decrease, which seems to be what is on the table, what is on the cards right now, we are okay. Our inventory levels are at similar levels. I think we have to decrease this to become leaner, to have more effective working capital utilization. So as with all problems, we have broken it into pieces for each business unit, assigned inventory to them. They the BU heads and our CEOs are all focused on ensuring that they are both capital efficient and also retain enough inventory to sustain revenue, prevent any revenue shocks. So we are quite comfortable with our positioning right now from a steel price point of view and our inventory holding.
And this BIW plant which we are started in Chennai, how is the scalability of that business, and what are we structurally looking that that business itself can be sizable business, or if you can give some highlight in terms of opportunities and scalability of that business, can we replicate in other location, kind of such opportunities?
So I think we have made a beginning in that business unit. Our current customers in that business unit are Stellantis, one of the top 4 auto companies globally. Most of the vast entirety of our production is export oriented for that plant. Growth verticals exist, growth capacities exist in that. We are adding Hyundai very soon as a customer as well. So I think building up the order book, which is already full for the next 2 years, increasing capacity steadily will be the course we will take. But yeah, the addressable markets are very, very huge in that business. So we can continue to scale that vertical, and the reason we set it up is to ensure that we can create a high growth and also high ROC, high margin vertical for ourselves in the automotive space. So yeah, we see good things ahead, but I think let us commission the plant, let us start scaling up, we expect profitability for that business unit in the next quarter itself. And I think once we have done that, we will present a long-term growth plan for that business. But right now, all systems are looking green, everything's looking good, and we are quite optimistic.
Understood. Yeah, I think we'll go back to the queues, and I will come back. Yeah, thank you.
Thank you.
Thank you. Participants who wishes to ask a question, please press star and 1. The next question is from the line of Vinit Jain from Rank Investment. Please go ahead. Ladies and gentlemen, the participant left the queue. We'll move to the next question, which is from the line of B. Surendra, an individual investor. Please go ahead.
Hello.
Surendra, please go ahead.
Hello, good morning.
Hello.
Sir,
Yeah,
my question is on that investor presentation. This presentation contains 12 pages, out of which 8 pages are the copy of the last quarter. Means this presentation comes, in the presentation, information, company has tried to hide out information, it's not providing the information. It seems like that. Sir, what is your reason? Why this is so? Over the period, last 2 years, if you are seeing presentation, over the period, this presentation is quality of presentation deterioration. There is no improvement. Number 2.
Yeah, okay.
Number 2, whereas you are giving 2 business verticals, why you are providing information on that is your 2 business unit-wise information on orders? Provide that way. If you want to hide out information, provide this way. Sir, I am a shareholder of this company last 25 to 30 years. I am following this company last 30 years, and I find that this company, this information providing, whatever information you are doing, these are the now a deterioration. When the chairman was there, the information was very good. Over the period, now this information is like a fishy information, foolishing the investors. I am straightway talking to you.
Okay, sir. Well, just
Sir, what I request is that if you have specific concerns about what information you would want, we will try to incorporate that.
No. Information we want, information you want, where are your units are there, where the units are there, like the tubes or whatever, solar or whatever information. That information was sales information or whatever. You should provide like this. You are providing one type of information, custom diversity in one way and other way. Does not give any information to other investors.
You would like to know the locations of our plants?
No, location of plant, I don't know. We have location of plant. We want the information of sales of the tubes wise, whatever your then there's a solar or whatever other information is there, that component or other whatever new divisions you are incorporated, what is their sales, what is their performance, what are the orders. But this is not happening.
You would want a vertical-wise breakup
yes.
of the...
Yes, in the presentation itself.
Okay. We have a certain revenue attribution we follow. We have many revenue verticals.
No, I understand you have got 25, 50, 100 verticals, I understand. But with those verticals who are contributing more than 10% of the revenue, you should provide the information. Rest you keep it the other ones from other verticals. Rename it as other verticals.
Yeah. So what we will do, Surendra ji, is your point is understood. Why don't we review? I will review it internally with our governance team with SEBI regulations as well. Where
is the SEBI regulations are coming in between? I don't understand, sir.
Sir, you would have to let me speak. If you just want to speak, you can.
Yes, I understand. I am hearing, sir. Tell me.
Yeah. What I'm saying is that you have made a request. We have understood the request. We will review it and we will get back to you.
Okay. Sir, one more question is on our credit rating report. Is there any credit rating report we have?
Yes, sir.
Can you, sir, upload in the system?
It is there on the web page of the CARE rating, sir, and it can be publicly viewed also. If you just type in the Google Pennar credit rating, you will get the report. It is publicly available report, and the CARE rating declares its report, which is available for everyone to view.
Okay, sir. Thank you.
Thank you.
Thank you. Participants who wishes to ask a question, please press star and 1. The next question is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah. Hi, Aditya. Can you hear me?
Yes, Dilip. Go ahead, please.
Yeah. So, before I ask my questions, just to echo the sentiment of the earlier, I was asking questions. I really feel that while the intention is to give a lot of data, the comprehensibility of the data can definitely improve. Considering the fact that we are a reasonably complex company, considering the size of the business. So yes, so what exactly we would like to see in the presentation is what are the key business contributors, what has been their performance on the quarter, and what is the trend, plus the initiatives you are taking for the key pivotal strategy points. I think those things are, missing, or maybe the investor, a lay investor, I'm not able to, see the presentation. And then there's a lot of repetition of the slides for people like me who are invested for long. I just see the same slide, doesn't make sense there. I can just go to the website and get past the thing. So that's about just to kind of chip into my bit regarding the earlier question. Yeah.
Allow me to respond to that, sir. I think what you're saying is that the presentation can be made simpler, more investor-friendly. You would want the presentation to incorporate, you said key business contributors.
Yeah, basically, 3-4 key verticals where the business, like the guy was saying, 10% or more. What has been their performance and what is the trend? Basically, what is that we are seeing going to be a future outlook? Plus 2-3 key pivotals, and you already covered the pivotals, financials, growth, and in terms of liquidity, and those 3-4 pivotals. That's all we want to know.
I think that's a very fair ask. What I suggest is this: the goal here is communication and clarity to our investors. I think yourself and the speaker before you, Surendra ji, have articulated an issue with the way the presentation is structured. If you can tell us the formats that you would want, we will do an internal check. We will take a look at what are the compliance standards which are applicable here. Reporting standards are different from what they were 5-6 years ago. I just want to make sure that everything that we present to you is information that we can consistently give you, and it is something that is obviously compliant with what we can't give any presentation also. That is also something that is That is important. But if you can give us the format that you would want, the communication you would want from us, we will review it entirely, and I will commit to you that whatever information format, public domain information format that you would want presented, I will ensure that is there, that is presented to you. But the key metrics here are public domain, and it has to be available publicly, and it has to be something that we can consistently provide to you quarter on quarter. That's the only metric here. But your point is well taken. Allow us for this. Give us this call for us to digest what you want. You have our email address. You have our investor communication details. Please tell us the details you would want. If you can tell us the format you would want as well, I assure you we will come back to you.
Perfect. I'll send it to IR department. My question, Aditya, is broadly two. One is the US business. I understand from the last communication to the exchanges that the US business order book has been extremely good. I'd like to get some color in terms of how is the order book looking like into looking at maybe this calendar year. Are we going to get a 50 crore kind of a run rate by end of this year, or whatever the run rate that you think we will be? So that is one. The second question is regarding the net debt has gone up to 500 odd crores. That's as per the presentation. So just wanted to know, our objective has been to reduce the cost of finance cost to 3.5% or lesser of the revenue. So what is that? Okay, if you can tell me what is the reason for this increase in net debt to 503 crores. And the third question is, is regarding the gross margin. We have been, told that the pass on of any increase in raw material is pretty much weekly. So what is the reason for the drop in the gross margin? Is it because of the lag effect, and when it's going to, and at what level it's going to stabilize? Yeah, that's all.
Let me break up the question, sir. The first question was on the US business, the traction we are seeing and what we expect. The next question was regarding our net debt and the corresponding interest cost as a percentage of gross sales and how we see that evolving. And your third question was on gross margin. So we'll take this up one by one. Our US business is now comprised of our metal building sales there, which is carried out by Ascent. Our tube sales, CDW tube sales there, which is carried out by PGM, and our hydraulic and engineering services sales. All four of these verticals are very well poised for growth. They have all grown over the last couple of quarters as well, and we expect further growth in this business. The order book that you speak of pertains to Ascent, and it has gotten stronger since the last time the press note that we had sent out. The plant has just started operations, and we are very confident that all of these initiatives start contributing to our PBT very, very quickly. So I am hesitant to provide the numbers to you per se, but when you said 50 crore, did you mean I can guide you around that? Did you mean 50 crore in terms of?
This particularly the Ascent business is only, I think, 6 months old. So are we going to see something around, say, 50 crore per month run rate going by, say, end of this calendar?
No, it would not be 50 crores per month for Ascent, sir. I think in this calendar year, the number, the broad indicative number you should look at is closer to about 15 to 20 crores per month. Okay. That is the number that you will see for Ascent alone. However, PGM, our CDW tube sales in the US, that itself will exceed another 7 crores, so you can add that to that. And our existing hydraulics and engineering services, which will also grow, will be close to another 7 crores. So overall, you can expect something approaching 30 crores per month plus in that business vertical over the next few quarters. And we will definitely achieve that in this financial year on a monthly run rate basis.
And I will assume all of them will be around 17 to 18% kind of EBITDA margin, right? That's what the typical pricing around?
Let me put it this way, sir. The overall for the blend, because they have a very differing blend of things, but on the overall that revenue number that I mentioned, you can assume a PBDT, which is after interest cost, but PBDT, not EBITDA so much, but after interest cost also is removed, of around about 12% is what you can assume. Above that itself.
Okay. Great. Thank you. That I got it. Yeah.
Understood. And now let's move to net debt. We have a net debt of 584 crores, and that is a high number. Our interest cost as a percentage of sales is at 3.35% to gross. 3.35% to gross. We intend to bring that down to 3%. Our debt, which is mostly short-term non-cash debt, LCs and others, is a feature of our business. This is something that will increase as our revenue increases. What's important is, as you said, the interest cost as a percentage of sales be controllable. So we are tapping a number less than right now. We are not efficient right now. We need to improve our efficiency a little bit more. But what you will see is this number being around 3%. And if it's around 3%, it is appropriate. In our view, it is an appropriate use of capital because it's mostly non-cash. It is, they include bank charges, includes a lot of other finance costs which are classified as interest, but effectively they are finance charges. So the 3% number is what you can take with you, and that we will ensure is achieved. And if possible, we need to optimize that as well. The underlying story on this is, if you look at the last 4 quarters, quarter on quarter from the pandemic, our revenues improved, our PBTs continue to improve. Of course, Q4 was a very good quarter. Q1, I would define it as, Q1 is always less than Q4, but from a pre-pandemic to now comparison, we are very well placed right now to both scale revenue and to scale profitability. I do believe that this year will be a very good year for us from a profit point of view. So with that backdrop in mind, I think net debt, since it is mostly the vast majority, 80% of it plus is non-cash, short-term debt, it should be seen in that viewpoint. It should be seen in relation to what the overall revenue number is doing, or the overall percentage interest cost as a percentage of sales is doing. So on both of those, we will commit to you that there are going to be controls. And most importantly, our target is to bring this 15%, 15.5% ROCE, return on capital employed, to 17.5% ROCE. So that would be our focus going forward. Gross margin for us, we are a blend of businesses, and we don't target gross margin. We target PBT. We target capital efficiency ROCE. So accordingly, sometimes in quarters you do see some swings. This is not emblematic of anything wrong going or an erosion of our margin from our customers, because some of our businesses have 30-40% gross margin. Some of them have only 12 or 13% gross margin. Gross margin being defined as margin after variable. But when you finally see it filter down to PBDT, since we target PBDT, we target PBT, you will see very good stability. So I think my request is that you hold us accountable for the bottom line, for PBT, and also capital efficiency. That would be the metric. On operating profits, there will be variations because of the nature of our business, because of the nature of the products we sell. If revenue attribution shifts from one product line to another product line, then that does have an impact on that. So those are my answers, sir. And if you need clarity further on any of this, we will.
That's where I was coming from. In terms of once we see a gross margin dip of 2.5%, that's a little bit scary for a company like ours, whose profit after tax is 2.5%. And so that's why giving details about the individual businesses takes away those apprehensions that where are we really going? Because if you see the gross margin of 19-20, which is around 40% coming down to 38%, means there's a 2% dip in gross margin. 2% back.
We look at the numbers you're comparing, sir, but I would also request my CFOs to chime in on this. But if you're comparing the first quarter of this financial year, which is what the conference call is covering today, if you compare that to the fourth quarter, it's about a 0.6% swing, which is very natural. Is that what you're comparing, the quarter one versus quarter two?
I am seeing this presentation. I don't know what is the slide number. The gross margin of quarter one of 38.5% versus 40.2% 100% of FY20, which is a likable year to compare, FY19-20. So if you really look at 40.9, 40.2 versus 38.5, that's where I'm coming from.
You have to look at that number in terms of Q1 to Q1 comparison, and in terms of Q1 to Q1 comparison, we are at 38.81% versus 38. I think the margins that you're looking at, gross profit margin percentages, it is 164 basis points. That's there in the presentation.
Correct.
Also includes other income component into it, which needs to be presented.
Okay.
So if you can remove the other income component, and then the number will be 0.61, sir.
Okay, fine. The last question, if I may, if I can get one more question to be put. This is regarding the railways business. There is a lot of government circulars around people coming and attending, offices compulsorily. So, is there any movement we are seeing in the railways business of ours in terms of, inquiries and stuff?
So, railways continues to be a little bit of a black box. Our railways vertical continues to be a little bit of a black box. As I mentioned, the last 2 quarters, we are not able to give you any guidance on that right now. What I can tell you is that the business unit is profitable, that we are planning for growth, but the railway board-based ICF, MCF orders, we don't have a lot of clarity. In my view, they have not fully recovered from the pandemic themselves. So how that will evolve over the next few quarters, once they get clarity, they'll pass that on to us, and I'll be able to pass that on to you. But as of right now, the only thing I can commit to is that the business unit is stable, but obviously nowhere near where it was before. But frankly, neither our growth story nor our PBT depends very heavily on that business vertical right now. If that revenue comes back, that's fantastic. It will it will be a big boost to us. But even if it doesn't, the numbers which we are committing to you, PBT growth quarter on quarter, capital efficiency growth quarter on quarter, those will persist. But as of right now, railways alone, we are hard at work building a long-term strategy on that. But once that is crafted, I'll send it to you. Our existing revenue streams, ICF, MCF, we honestly have no clarity right now.
Sure. Because, this number, 140 crores, is pretty much static for a long time. I was just wondering, we are not getting orders as well as we are not billing the pending orders. That's what I was, my question was.
Good question, sir. So, it is. I assume you're saying 140 crores order book. So what's happening is we are invoicing the same amount, we are booking the same amount, which is around 10 to 12 crores per month, range bound almost. So it's not less than that. It's not. It's not more than that also. So that's why it's more or less in that around that 140 number. But what I can tell you is that the business unit, the CEO of that, Mr. Dayasagar, is someone with decades of experience in this industry. We are ramping up our export orders for that business. We will very soon give you more clarity, but there is reason to be optimistic. It may take us a little more time, maybe a quarter more, but I think we will be able to give you a lot of clarity on that. And but for now, right now, as it stands, you can expect sustainability on that from an order book point of view, revenue point of view. So sales are happening per month. So the order book is not static because no sales are happening and no order booking is happening. It's static because the order booking and the revenue is matching. That's the...
Yeah. Thanks, Aditya. Really appreciate your candid answers, and I will come back to your IR department on the expectations.
We would appreciate that. Please do tell us the specific communication clarity formats you would want, and we will absolutely do our best. Our goal is to communicate clearly, and we will make sure that happens. So thank you so much for your questions.
Thank you.
Thank you. Participants, to ask a question, please press star and 1. The next question is from the line of Venkat Subramaniam Raman from Organic Capital. Please go ahead.
Hi. Yep. Congratulations on good set of numbers under challenging circumstances. My questions have been standard actually. I've raised this a couple of times actually with you. Our profitable divisions are basically hydraulics, railways, pipes. environment and currently the US-based businesses. Many of these clearly have much superior margins. There are a whole set of other businesses which are probably, pulling down ROCE, which is really what you're focused on. And it also poses the challenges that the other shareholders are posing to you, which is in terms of more disclosure and all of them. I appreciate, your challenges in terms of, making it more complex in terms of how to give this. So my views are a little different from what others have raised. But my question is really, why is it that we're still looking at other businesses which are margin dilutive?
So, good. Thank you for your question, sir. So what we try to encourage above all is sustainability. And that sustainability should be in revenue and in margin protection. So you are right that some of our businesses are higher margin than others. But the basic metric we use when we look at whether we should be in a business or not is we ask if we have a core capability of delivering value in that business. Do we have the physical assets? Do we have the manpower, the IP, the know-how in order to deliver value? And value should be a thing of margin. And that shouldn't be just for 1 quarter or 2 quarters. It should be over the medium term. So we do have verticals right now, and I'll name a few of them. For example, our pre-engineered building vertical, which are at lower than expected margins. But over the long term, we believe them to be strong contributors, or they will be strong contributors. Unfortunately, for these kind of businesses which have big engineering teams, which have structural engineers, project managers, and others, sometimes when there is a down cycle from a capital goods sector, they do tend to underperform. However, the question we ask ourselves is, what is the long-term viability? Will people still be making buildings 5 years from now, 6 years from now? If that is the case, then we go ahead and do it. If we feel the answer to that is no, and that we will either A, not be able to deliver value for whatever reason, or B, the business itself will not be viable after a certain period of time, 4 years, 5 years, 6 years, then we exit that business. So we have made several of these choices in the past, and we will continue to make them. Our goal is, yes, capital efficiency, but also sustainability and the impact that we make. So that metric we will use. And what you said, which is that remove the low margin business so the ROCE increases, is absolutely appropriate, and we are hard at work to ensure that happens. And the way that will play out is a consistent ROCE improvement, which if you look at the last 3-4 quarters, if you go back 1 quarter, our trailing ROCE would have been very low. Now it is up to 15.5. I think next quarter you will see further improvement on this. So improving ROCE, improving PBT margins, improving capital efficiency which is effectively ROCE, of course.
Ajay, the question was actually in the context of just 2 things. One is actually 2 of the scarce materials, the 2 things that are very material from a Pennar point of view is management bandwidth, which is involvement of your time and senior management time. And most of our businesses are capital hungry. So therefore, for us to ration it a little more meaningfully, I'm wondering whether we should be walking around with scissors rather than actually wanting to, fuel all the divisions at the same pace.
Good points. I think those are definitely the 2 bottlenecks we have. Management bandwidth and capital is obviously finite. Nothing deserves or nothing is can be given infinite capital. We are absolutely doing what you're suggesting. It may just be moving at a pace that is slower than it should be. But our preference is to, we see diversity of revenue or doing too many things is obviously bad. It prevents focus, it prevents specialization, it prevents value addition. But the way we see it is we have to make these choices, not just seeing the current capital efficiency, working capital, and taking that into account, but what is the long-term viability of a business? What are the businesses we should be in and Pennar? What is the business we should not be in? That is something we have to follow up. Your point is absolutely right in that. And we are making these decisions quarter on quarter, but we're doing not just using the metrics of current capital efficiency, current bottlenecks, but long-term sustainability and viability of businesses is what we will. For example, railways is a very high margin business, but as it turned out during pandemic times, railways is not sustainable. Does that mean we're going to exit that business? Well, no, we should not do that because when we are sick, but we will get better. So when this capital goods sector is constrained right now, it will get better over time. And I think we have to prepare Pennar to be a company that can sustainably deliver good returns on capital. And that means when you break the problem into pieces, all of our business units have to do the same. So we will reduce the businesses units we have. We will become better at communicating what each business unit is doing. I mean, some of them are order book based, some of them are just scheduled revenue based. But giving clarity to all of our stakeholders is critical, and also being capital efficient has to be the metric we use. So the only thing I'm adding to that is long-term sustainability. I mean, there is cyclicality for some of these businesses. So we have to be capital efficient, conscious of where we are deploying our capital and our manners, obviously, as you also said. But overall, I firmly believe we are crafting a set of businesses which are well poised to scale well in the future, and they will be 4 or 5 businesses. They won't be 10 businesses. So we are going to ensure that happens. So, Subramaniam ji or the operator, can you hear us?
Yes, sir, we can hear us. Mr. Raman, can you hear us, sir?
I think they may have been a...
Hello? As there is no response from the line, we'll move to the next question, which is from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Sir, just wanted to cross-check what I heard. Can you share the gross debt and cash balance number?
In terms of gross debt, and as of consolidated 30th of June, we are at 591.63 crores.
Okay, and cash balance would be around?
Cash balance would be close to around 55 crores.
Okay, that is more or less. And next question is regarding this outlook on PEBS business as well as this solar kind of thing, the way government is promoting renewable energy sources and Atmanirbhar Bharat, particularly looking at this solar panel manufacturing also. So how that is shaping up in terms of opportunity for solar business? And second, on your outlook and margin profile on PEBS broadly.
So solar continues to do well for us. I think in our MMS business, though the solar industry per se had a lull period with only 5 gigawatts overall in the country being implemented, we were able to maintain a substantial order book, and that continues. So from a broader perspective, we expect our solar revenue to be higher. And this plays into a little bit of what I was talking about in the last question, which is that solar was a business that was not doing well 2 years ago. It's doing well now, and I believe it is going to do well next year. So we need to evolve a framework where we look at these as long-term opportunities, understand that there will be cyclicality sometimes in some of these business verticals, and then depend on the other business verticals to bear the load, so to speak, when there is cyclicality. If we do this and we have, I don't like using this word, but if we have that diversity in revenue streams, diversity in profitability, what it does do is ensure that we don't have a sudden crash in profitability. It ensures that our capital efficiency holds up, because these are volatile industries. I mean, solar will have an up cycle, it will have a down cycle. Automotive will have an up cycle, will have a down cycle. I think we need to structure ourselves in a manner so that we can ensure that solar, will it be there 5 years from now? Yes, I believe so. I think solar is a long way to go. So we will continue to have our capabilities, invest in our capabilities in this business. But as of right now, solar looks quite strong, and this year and next year we are projecting growth. For PEB as well, a lot of the same argument stands. The capital goods sector has not been doing very, very well, but over the last 3-4 months, there's been a fair amount of recovery. Our order books have been growing continuously in PEB over the last couple of months. and the revenue has scaled up. The business unit is obviously profitable. I think with what we have, our own projections for that business unit, I think quarter-on-quarter improvement will definitely be there. And once there is a broad-based recovery in the Indian economy, which is not just the commodity companies doing well, but engineering, process industries, everyone doing a lot better, going in for expansion, as they seem to be right now, then PEB will take up. I don't see it in any way not taking up. But even right now, it's profitable and focusing on improving revenue and growth and scale. And Q2 is for the overall company and for PEB is far stronger than Q1. So, yeah.
And in terms of EBITDA margin for PEBs, are we at a healthy level or we are still below like a sustainable level and there could be a recovery coming forward?
The EBITDA margin and the PBDT margin and even the PBT margin for PEBs will continue to grow. As of right now, it is in low single digits, the PBDT. We expect it to scale very soon. It is ultimately a scale impact. The gross margins are very healthy, high double digits. But once our order book continues to grow, once we convert a lot of that into revenue, then we'll hit the higher PBDT numbers from a percentage point of view.
Got it. I think that was helpful, sir. Thank you.
Thanks, sir.
Thank you. Ladies and gentlemen, as this was the last question for today, I would now like to hand the conference over to the management for closing comments.
Thank you to all our stakeholders. We have taken the feedback that we have received on this call. The questions covered steel prices, our US investments, and also our net debt and interest cost, and how we improve capital efficiency, how we improve margins. I think a couple of the stakeholders also had requested that we change and improve the quality of our communication and clarity in our presentations, give more information. We will work with those stakeholders and others and ensure that all publicly available information is crafted in a way so that we can ensure better communication, better clarity, so that you have the information you need to guide us further as well. Thank you very much for your questions, sirs.
Thank you. On behalf of PhillipCapital India Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your line.